Hey traders, Nick Shaheen here. Little lesson about managing trades and risk and all of that. So one way to trade an event or a bounce or a move that I see, like if I develop a thesis that stock A is going from here and it's going to rise X% in the next few days or weeks, and I choose to take a trade. Specifically here, it's for Facebook. Last night, obviously there was an event, a news event, and I chose to bet up. The short-term reaction I wasn't too confident with because it's a complete coin flip in the short term. So I wanted to bet up, but in a hedged way. I don't want to just grab a handful of calls or buy the stock with so much uncertainty. Actually, I should switch to Facebook while I'm talking about it. Okay, so this is the reaction that happened here overnight. Obviously, positive reaction. It's fading here a little bit, but it is a positive reaction. So what I chose to do is a calendar. So let me go grab a picture of it. Alright, so that would be a put calendar. I chose to buy the December 155 calls, and they cost yesterday $5.40. Pretty expensive, correct? So to lower my entry cost, I sold the 162 calls against them, and I collected a little over $1. So now my net cost is this much, $4.33 was. And these expire this week by Friday. So what I'm saying is I'm long at 155, I'm short at 162.5. And this morning's high was, I think, 156 and change. So it was kind of a perfect snap of perfect grab of this of the levels at play. I wasn't just guessing. I actually did some homework to see where the levels are likely to go, where the expected move and everything. So the lesson here is how to use diagonals, not just calendars or debit call spreads, regular vertical spreads. So usually vertical spreads will say, okay, I bought the December 155, I'll sell the 160, and I'm good to go. I pay an amount, and then I need price to rally through. Okay, that's the regular vertical spread. Now I can do it a calendar spread by saying, okay, I bought the 255, but instead of selling this one above at 160, I'd sell the this week's 155 against it and collect a lot more than $1. I collected only $1 because I went up to 162.5, so I went up to here. Okay, so the call calendar would have looked like this right here, one line, same level. I buy December, I sell this week. But in this case, I mean, in hindsight, it actually probably would have worked out, but I chose to go diagonally to give myself some room. So what if it rallied 15%? Then I still profit versus this one would be stuck. You guess the right direction, you end up making nothing out of it because it blew through your levels. So that's the difference between a diagonal and a calendar. So vertical, calendar, diagonal. Does that make sense? So December, I buy, I sell. That's a vertical. I buy, I sell. That's a calendar. I buy, I sell. That's a diagonal. All of these are called spreads. Call spreads. They're debit because I pay to enter them. They're bullish because I need a move up to win. This one, I win if it moves up to 1,000,000. This one I don't win if it moves up to 1,000,000. This one I win if it moves up to 1,000,000. Makes sense? All right, in this case, these are actual numbers from this morning. So it cost me $4.33 to enter. At the time I took the snapshot, it was $7 to close. So I could sell the whole thing and make the difference in profit. One contract would be, what is that? $2.70. So $270 for one contract. So I could close just these and be short Facebook at 162.5 for another 5 days if one chooses to do so. I don't like to be short stocks, but that would be one option to do it. But for 27 cents or 28 cents, I'd like to sleep tight and get rid of the whole thing altogether. Or stay in it, let this one die for 0, if Facebook meanders up above this level by Friday, and just be long this one naked through December at 155. So is that a viable thesis? Okay, let's look at Facebook chart. So we're right here. We're coming up on a prior accident scene, so there's going to be resistance. In fact, it already entered resistance. I'd be shocked if they don't fade it a little bit. And then 155 is not that far. I mean, I'm in the money almost, so any move up into December for a Santa Claus rally would be profitable for this naked long 155 call. Now I could roll this one out 1 week and stay hedged, meaning I close this, I buy this back, I sold it for $1, I buy it back for 30 cents, and then sell next week's and collect more money, thereby reducing this entry cost even further. Correct? Hopefully that all makes sense. All right, Nick signing off. If you have any questions, let me know.